This screencast is looking at the third question from question pack 5, and in particular we're focusing now on exam technique and how to approach a larger question where we're asked for all three financial statements together with a number of adjustments. So again, what we're looking to apply is what the steps that we covered in class. Now these steps are based on the columnar approach. So if you do use the T account approach, that's fine. You may have to tweak these steps slightly to again fit to your approach. But again, it's important that you do have an overall structure to how you approach consolidated questions, because otherwise it's not going to get finished in the time and it's not going to be easily followed when you're correcting it. So the first two steps are really to try and set the scene in terms of read the requirements first to figure out how many financial statements you're required and the background of the case. And again, I always tell students, make sure you review all the notes before you start the question, because many times notes can be interlinked, and if you don't read both notes together, you'll have to go back and redo the requirement. So again, make sure you read all the notes just briefly, just before you start into the question. And the next two steps then are really just setting up the question structure. So once you know how many financial statements, you leave enough space at the start for the financial statements and set up the relevant column structure, particularly for the statement of financial position, but you can also set it up for the SPLOCI as well. So they're the first four steps that we're going to look at for the third question, and we'll then look at the rest of the ones as we work through the question. So again, I'm assuming you've read through the question now and hopefully attempted it. If not, pause this screencast and at least start the first element of it, perhaps as far as the goodwill working, and then step back in and see how you approach the question in comparison to this approach. So again, the first thing is to read the requirements and figure out what you're asked to do. So in this question we're asked with the three full financial statements, so we know we have the P&L, statement of financial position, and also the statement of changes in equity. So a quick read of the background of the question. So we're told here, financial accountant and Herd resolve a number of issues. They acquired 3 million ordinary shares and 90% of the preference shares of cattle on the 1st of January 2010. So key things you want to be highlighting here is, well, 3 million ordinary shares equals how much percentage? And if we go down, it equals 3 over 5 million is 60%. Therefore, it's a sub. So I'll be writing that down straight away, just jotting it on the paper. That's a sub. And watch, put a circle around. If you have preference shares, you have two different ownership splits. So that complicates the goodwill calc slightly. The ordinary shares were acquired for consideration at 320 each, and preference shares were acquired at par. So again, we can see that if we look at the calculation, 3 times 320 is 9.6 million. So you paid 9.6 million for the ordinary shares, and you bought 90% of the preference shares. So 90% of 1.5 million preference shares, you bought them at par, is 1.35. So 1.35 million plus how much you paid for the ordinary shares should hopefully give you your investment amount of 10,950. So 1,350 for your preference shares plus 3 million times 3.2 is 10,950. So sometimes you'll be given those in questions where you're just told the investment but it's not split out. But that's what the figure is coming from. You're told that in the background of the question. So then you're given a fairly straightforward statement of profit and loss and other comprehensive income for herd and cattle. I would note, and I would always circle other income, that may have an intergroup dividend element. So that's a thing that you'll see as you practice through questions. So I'd highlight that and say a possible issue. You're given the statement of changes in equity, so that obviously should be changes. And note there's dividends here. So again, I'd put a big circle here. If the sub is paying a dividend, we're going to have adjustments. And note herd, that's the parent paying a dividend. That's okay. We have no major adjustment there. Just to remember to put it into the consolidated statement of changes in equity. But again, I draw a link there. We're going to have some intergroup dividend adjustments. In the statement of financial position then, nothing really out of the ordinary. We have the investment in cattle and we know what that figure is made up of. They have another investment in guild, so we'll try and see in the notes what type of investment that is. Is it a sub, associate, joint arrangement, or is it just a simple investment? Nothing else unusual here. We know we've preference shares and we know we own 90% of them. So that means the NCI owns the other 10%. And now we have a quick look at the notes to the question. So at the 1st of January 2010, which is the acquisition date, the net book value of property was 2 million and a fair fair value of 5 million. Therefore, you're going to have a fair value adjustment, and 50% of that was land. So again, only half of it was actually property, and that's important because when you make your depreciation adjustment, we only ever depreciate land, or we only ever depreciate buildings and property, should I say, not land. So we know that one, just brief look at it, it's a fair value adjustment and depreciation. The next one is herd sold goods to cattle during 2010. So the thing I'd be noting there is that's the parent herd selling to the sub. So we're not going to do it, we're just having a quick look through the notes so we know what's come up. So that's okay, and we're told different information then about what the detail was in terms of the unrealized profit. But the main thing there is the direction. It's herd selling to cattle, so it's the parent that's making the unrealized profit. We're told that the preference shares are non-redeemable. Again, the main reason you're told them is because they're treated as equity. So that's why they're presented in equity here. If they're non-redeemable, they are equity. And finally, then we're told the information about the investment in Guild is a 15% shareholding acquired during the year at a cost of $850. And now the fair value at the end of the year is $1.2 million. And the directors want to include this in the financial statements. And dividends received from Guild have been included in investment income. So now we know this investment income here of 481 includes dividend from Guild and also some intergroup dividend. So we'll have to deal with that in our adjustments. So that's essentially all you typically do initially. That should only take a couple of minutes, but it's good to read through the structure. We know what's come up now in terms of fair value adjustment. We know we've intergroup trading. We know we've intergroup dividends. So it just sets the scene, and you get a good idea in terms of where you start with the question. The next structure is setting up the answer in your booklet. So leave enough space for the three financial statements, and also set up the column structure, typically for both, which will allow you to jot in adjustments as you go along. So for example, I have this set up already. So I have one page set up for this blocky, and I have the full parent in, and I have the full subsidiary. And note I have 12 over 12 months as a little reminder, because you always ask yourself, is the full amount of the subsidiary in, or was it a mid-year acquisition? But we acquired this subsidiary on the first day of the year, 1st of January 2010, so it's the full year. So I leave one page for this blocky with two adjustment columns and then a sub across to the group. Same for the statement of financial position. I leave the parent and the sub. And remember, you'll remember now as you go along to leave a line for goodwill in case you have it, and also leave a line for NCI, which you more than likely will have. But again, that will come in practice. If you don't like to use this column approach and you just like to put in a single figure at the end, that is fine as well. The key point being, I want to be able to see where all your workings are coming from. So this makes it very clear where they're coming from. But if you have a different approach, that's fine, as long as it's kept neat and it's easy to follow. So I typically leave 2 pages for a statement of financial position and set up the structure. And finally, then a consolidated statement of changes in equity, I leave another page because we know we're asked for it here, and we'll fill it in at the very end. So the consolidated statement of changes in equity is the last statement to be prepared. So that's your other 2 steps of setting up the structure. And then once you have those pages skipped, all I typically do is go down to the next page and set up an appendix for my workings. So this is where I'll do my individual workings, show my unrealized profit adjustments, and show my main workings such as goodwill, NCI, etc. And I typically split this between the smaller consolidated adjustments, which I call Journal 1, Journal 2, Journal 3, and the bigger key workings. So you'll see in a lot of the solutions I put out, I keep the workings over this side where I do working 1, for example, will be goodwill. Because a lot of these key workings, such as goodwill, the non-controlling interest, and group retained earnings, all of those will have multiple adjustments. So I do the smaller adjustments individually, and as I do them, I bring them into the bigger workings. So it just helps that you can do them simultaneously, and you're not trying to go back over and repeat yourself each time. So you'll see what I do typically is I lay out the little journals here, and you might do them in a couple of pages, and keep a separate page for your main consolidated workings, which is typically in this case will be goodwill, retained earnings, and the NCI. But again, as long as you have a certain approach that you keep it neat and it's clear, that'll be fine. So once you have that laid out, the next step is to actually work down through the adjustments and again fill in all the key workings as you go along. So you'll work down through each of the little notes, which is typically linked to an adjustment, and then you'll do the broader workings as they come. So as you do the goodwill, and you'll fill in those adjustments into the goodwill working, into the relevant financial statements as you work through them as well, to avoid having to go back over them at the end. So now that we've that step sorted, we're going to start with the main workings of the question. Particularly the first thing you typically start with will be the goodwill working. So I typically leave the goodwill one here. I start with the total, and then I split that between the parent and the NCI. So for example, here we look at the investment slash the value for the NCI. So just split these out. So we know the parent has invested 10,950 in the herd. So herd have invested, 10,950 in cattle. So for their share of 60% of the ordinary shares and 90% of the preference shares. So 10,950 is how much they've. And we're told in the NCI, so we're not told that they're valued at fair value, so we assume it's going to be method 1, the partial method. So we then have to figure out, well, what is the fair value of net assets at acquisition? So that's going to be made up of a number of elements, including ordinary share capital. So we go back and we look at what else is in it. You have a share premium account, preference shares, and retained earnings. So share premium, you have retained earnings, you have preference shares, and note with preference shares it's a different split. So make sure you get that split right, that it's not the 60-40 split of ordinary shares, it's actually a slightly different split. Right. And finally then, don't forget you're going to have a fair value adjustment from note 1, and we'll deal with that in a second. So the ordinary share capital is 5 million. The share premium is 1 million. The retained earnings, and be careful here, we're looking for the retained earnings at the date of acquisition. Retained earnings at the year end is 3130, but we want retained earnings at the start of the year, which is 1985. Sometimes you'll be given an extract from the statement of changes in equity, but sometimes you'll have to work back, take off profit for the year, and add back dividends. So again, in this case it was done for you. In other questions you may actually have to work from the notes to work back to the 1985. But the date of acquisition was the 1st of January, so the retained earnings at that date was 1985. And the preference shares in this case were 1.5 million. And we then have to go over to our little journal 1 and do our first adjustment. So our first little smaller console adjustment, bear with me there, is the fair value adjustment. So in this case we're told that the fair value of property was 3 million more than its book value. So you're going to debit PPE 3 million, and you're going to credit the goodwill working 3 million. So that's your fair value adjustment at acquisition. It's going to be 3 million. And the benefit of having the structure set up is, instead of leaving till the end, we can now put the adjustment in, 3 million into PPE, so we won't forget it. So that's the journal adjustment, and I just slot it in to the adjustment column. And we're going to credit goodwill working, so that's going to be 3 million of a fair value adjustment. So the total net assets at acquisition are 12,485. Right? And we then have to value the NCI. So remember here that the NCI is not just 60-40 split. It's going to be, we have to sum up everything except the preference shares, and that's going to be at 40%. So everything except the preference shares is at 40%. And then the preference shares are going to be at 10%. Because remember, we bought 90%, the parent bought 90% of the preference shares, so the NCI must have 10%. So that's always be tricky when you have preference shares. Watch out for the different ownership splits. So the NCI is going to be valued at 4544. Of course, that's going to be the same amount here because it is the partial method. And then the parent, if you want to check, so we just add them up, giving you the total is 15,494, giving you total goodwill at acquisition to be 15,494 minus 12,485. So it's 3,009,000. So that's the goodwill. And just to confirm that it's nil here, because it's 4,544 minus 4,544. And the proportion, let's bring this down, for the parent, just to sense check we're correct, the parent owns, so if we sum everything except the preference shares, they own 60% of that, and they own 90% times 90% of the preference shares. So that's 7,941, and if we take how much they paid for what they got, it's 3,009. So it's just good to sense check that you're correct. In that case, the goodwill on acquisition is 3,009. And note we've no impairment during the year, so we can simply slot that 3,009 into the statement of financial position. So because we know we've read through the notes there's no impairment, we can go goodwill. I'll do working 1. So to reference, I've shown a big working there, and 3,009. So it's nice to do it as you go along because it saves you time at the end because you're already slotting them in as you go. So the goodwill there working is 3,009. So the fair value adjustment is the next thing we need to finish off. We've done the initial fair value adjustment as per the 3 million, but we know now that 50% of that is land. That means 50%. So 50% is property, which is depreciated. So that means 1.5 million is to be depreciated, and it's for the full year because the acquisition is at the start of the year at 2%. So you have a fair value depreciation adjustment, and it's going to be 1.5 million times 2% for the year. So it's a 30,000 euro, and you're going to credit PPE because you're going to additional depreciation, because if you make a fair value adjustment you need to charge depreciation on that additional amount, and because it's a fair value adjustment you will split it between debit group retained earnings and debit NCI. So you need to split that 60-40 because it is in the subsidiary that you're charging the additional depreciation. So that's 60% and that is 40%. So 18 and 12 for the retained earnings group and the NCI. So some students will now open up a working 2 for the NCI, and just to slot in the adjustment to remember to do it again. So I put this in here, depreciation adjustment, journal 1, and I'll put in a minus 12 because again remember you're reducing the NCI. And I might also open up my group retained earnings working, and I might skip a few lines because you need to start it and put in a depreciation adjustment, journal 1, of minus 18. Now you don't have to do that, you can leave it at the end, but sometimes students like to do it simultaneously to avoid forgetting the adjustments at the very end. And the final thing you need to remember here is that full 30 is going to go into the SPLOCY, the consolidated SPLOCY, and it's to do with the sub. So we've talked about this in class, how you use the label of the stars to remember to put into the SPLOCY, and also use the S label because that will involve calculating the subsidiaries' profits for the NCI at the very end. So I'll put that 30 in. I've increased depreciation of minus 30. So just reminded myself that that should go in, and I'll do it simultaneously, or you can leave it at the very end. Either or, depending on what approach you want to take. So that's the first portion done. We have our goodwill calc done. We have our fair value adjustment initially, and the subsequent depreciation, and tracked it to the main workings, and also to the SPLOCY. So there's a lot going on, but the more questions you practice, a lot of these adjustments are very similar. The next one we're dealing with here is the parent to sub trading. So the parent should be to the sub intergroup trading. So in the question here, we're told that herd sold goods to cattle during the year. These costs They cost the seller, which is the parent, 390, and they sell a gross profit margin of 25%. So that's important. It's not the markup, it's a margin here. And all of these goods were sold to third parties at the year end, except for one item. So the unrealized profit is only on this item, which is included in cattle's inventory at 20,000. So there's a lot of moving parts here. The first thing we need to figure out is how much was the total intergroup transactions, because we need to remove them from revenue and cost of sales. So total cost to Herd was 390, and remember they charge a margin of 25%. So to get the revenue, i.e. the price that Herd would have charged, if the margin is 25%, costs must represent 75%. So that was a tricky one, that you need to know the difference between markup and margin. So in that case, to get the revenue that cost would have charged, it's 390 divided by 0.75, or divided by 75 multiplied by 100. In this case, the actual revenue, or the amount that Herd charged cattle for the transaction, would have been 520. Because 520 minus 390 gets me 130 profit, and that is, if you put it over revenue, 25% margin. So that was a tricky thing, so watch the detail of the question. So your first adjustment is to debit revenue, credit cost of sales, to remove those intergroup items because it's overinflated revenue and it's overinflated cost of sales. And again, both of those are going into this blocky. So in this case, you're going to reduce your revenue, minus 520, and you're going to reduce cost of sales. So remember, it's a positive figure because that will reduce the costs. So that's your first step, is to remove the top level items, the revenue and the cost of sales. Now, the unrealized profit is not the full 130, because remember, you're told in the question there's only one item left in stock and it's valued at 20,000, and that's how much cattle bought it for. So cattle bought it for 20, and there's a profit then of 25% on that. So the sale was 20. That means the unrealized profit will be a quarter of that, which is 25%. So remember, it's the parent selling, so you're going to debit group retained earnings, 5, and you're going to credit inventory, 5. So you don't remove the total profit because a lot of that is now realized. You only remove the unrealized portion. Of course, that goes to the P&L because it is a current year adjustment, and that will go to the statement of financial position to reduce inventory. So if you reduce group retained earnings, I'll put it in here as well. Unrealized profit, journal 2, minus 5. And you're also going to come up to group retained earnings up here, and you're going to do a minus 5 for cost of sales. Now, whether you put that in OPEX or not, typically it probably will go in cost of sales, and you will reduce your inventory by the 5 as well. So it's nice that once you do a working, you can slot it in where it needs to go, and it avoids duplication of the work again at the very end. So we're reducing our profits through retained earnings and through the P&L, and we're reducing our inventory for the same amount. So that has dealt with the intergroup trading, both the top level items and the unrealized profit. The other thing to watch for intergroup trading is any intergroup balances, but we're not told there's any intergroup balances at the year end, so we don't need to worry about that. There's no adjustment for note 3, but there is an adjustment for note 4 that we're told the investment in guild, which is in the statement of financial position of 850, has now been revalued to 1.2 million. So for journal 3, this is a simple investment because you have no significant influence. So it's a simple investment, and you account for it under IFRS 9. So when you make the fair value adjustment, you're going to debit investments. The difference is 1200 minus 850. So increase investments by 350, and credit group retained earnings. And of course that will go to the P&L as well, because if it hits the retained earnings, it's going to be a movement in the P&L because it's the current year. So I'm going to increase group retained earnings by a fair value movement. reference journal 3, and that is 350. And I'm also going to increase the element in my Splocky by 350 as well. So whether you want to keep that as a separate line item, or you want I'm just going to put it into operating expenses. You may want to put it into operating income, and that's fine, just to be consistent with the solution. And don't forget to increase the investment 850, so that should be 350 here. So that should be up to the 350 should be here. So that's from the prior solution. So it's now 850 plus 350 gets me to 1200 overall. So I just show my adjustment there to make sure it's consistent. So I've increased my profits for the year, or a gain, revaluation gain, and I've increased my investment. So I'm just keeping track as I go along, and it's captured in here as well for the final adjustments. The final thing we need to do here is, it's not clear from here, but we have intergroup dividends. So it's important here, you know you're going to need to make adjustment. There's been dividends paid during the year. We know they're paid because they're not outstanding at the year end. So if there's dividends paid, we need to figure out what portion of that is intergroup. Alright, so Journal 4 deals with the dividends. Our dividend was paid was 500. So this was by the sub, by cattle. Ordinary dividend was 500, of which 60% was intergroup. So 60% needs to be adjusted and removed from the other income line in the P&L. So remember here, we're not worried about any other adjustments because the dividends are paid, so there's no corresponding dividend receivable, dividend payable. And for the preference dividend, that was the amount of 90, and the intergroup amount will be 90% of that. So remember, different ownership percentage of 81. So we also need to adjust there. So the only thing you need to do when there's a dividend paid is to remove it from the income statement. So of that 481, 381 is actually intergroup. So it doesn't make sense to show it there. You need to remove it. You'll have no adjustment in the statement of financial position because it is the dividend is already paid, so we don't need to worry about it. What you will need to show though, and it's useful to do it here, is the NCI dividend, and that will go to the statement of changes in equity. So remember, the NCI dividend does show up, and it will be the ordinary dividend times 40% plus the preference dividend times 10%. So it's good to make sure you figure out what the NCI dividend is, because that will show up in the statement of changes in equity at the very end. So that is 209, and you do also have a parent dividend which was declared during the year of 750, and that will also go to the statement of changes in equity. So it's useful just to label those to remind you when you're finished every other statement that you have to prepare a statement of changes in equity, and both of those dividends will come up. Not the full subsidiary dividend, but the NCI proportion. So we now have all our smaller consolidated adjustments done, 4 of them, and we're now just going to finish off our main adjustments. So we have our goodwill done. We now need to finish off the NCI. So remember, the NCI, you start with that measurement at acquisition. So the measurement of the NCI at acquisition was 4544. We had one adjustment from our smaller consolidated adjustments during the year, and we now also have to give them their post-acquisition profits. So I might just move these two out a small bit. So with one adjustment during the year, the post-acquisition profits of cattle, well, we need to figure out the closing retained earnings for cattle is 3130, and the opening retained earnings was 1985. So that's how you do it. It's 3130 minus 1985, and they get 40%. So in this case, the post-acquisition profits are 3130 minus 1985, and they get a 40% of that. So that's 458. So you bring that share over, 458. That will give you the NCI at year end to be those added up together, is 4990. So the NCI at the end of the year is 4990. It's what you did at acquisition, plus any adjustments during the year, plus their share of post-acquisition profits. So the NCI share. Now you may do that slightly differently or present it slightly differently, but as long as you come back to the overall answer 4990, that is fine. Because there's different ways to present it depending on how you've thought it before. But the 4990 now needs to go in to the non-controlling interest. I cross-reference there working 2. And I don't need to show all the adjustments there. I just show the 4990. So it's nice and neat, and you can clearly see where the working is coming from. Similar for group retained earnings, the starting point is always the parent retained earnings at the year end. That's always your starting point. So the parent retained earnings here is 5160. So 5160 is your starting point. You have a number of adjustments made during the year. So you have unrealized profit, depreciation, fair value, and the sum of those is 327. And the final thing you need to do is give the post-acquisition share from the subsidiary of profits, post-acquisition profits from cattle, for the parent share. So you can see here we give the NCI share here, which was 40%, and now we're giving the 60% share to the group retained earnings. So you always take the end of the year retained earnings minus the retained earnings at acquisition times the relevant share. So here it'll be 3130 minus 1985 times 60%. So that's their share of post-acquisition profits for the year, or 687. So if we add up them, that gives us 6174 to be the group retained earnings at year end. Now, as I said, you may have a slightly different presentation of that, whether in some of the solutions you may split it between the parent adjustments and all the sub-adjustments, and that is fine as long as you come back to 6174 to be group retained earnings overall. There's a number of different ways to present it, and we'll do working 3 here, 6174. So you can see for the major workings, we typically don't put adjustments in here. We keep it down to a separate page and we cross-reference the workings in. So it's important there's smaller adjustments that feed into the bigger workings that then will feed into the financial statements. So the more practice you get at that, the better you'll become. Okay. So the one other adjustment that I've obviously forgotten to put in, I should be crediting this 30 for the accumulated depreciation. So for the depreciation adjustment of the year, now all I'm going to do is work back down towards finishing off my statement of financial position first, then my SPLOChy, and finally my statement of changes in equity. So once you have all those adjustments made and you've them totted in, all you're now doing is summing across. So you'll sum across parent plus the sub plus any adjustments, getting you to 29,531. Remember, the investment in cattle is now gone because you use that in the goodwill calc. So that is going to be nil, and you've now non-current assets of 33,740. So again, remember to take out your investment in cattle, and the corresponding lines down here will also be taken out because all of those figures are gone into the initial goodwill calculation. They are a little one that a lot of students tend to forget. Again, for the rest, it'll be relatively straightforward. You're just summing across parent, sub plus adjustments for each of them and summing up the totals. So again, we won't spend too much time on that, but as long as you do the workings first, set up your adjustments, the totting of the financial statements takes relatively little time. Here you need to remove all the subsidiary items because they all have gone into the goodwill calculation. So that leaves you with 20 million from the parent, 3500 and 0. And we've already our retained earnings calc done. So you just tot them up, gets you to 61174. So you can remember, if you're struggling at any stage, pause this screencast and go back and try it yourself, and then come back and see can you work through it. And we've our retained or the NCI calculation done from working 2. Tot that up with the other equity, getting to total equity of 66,164. So obviously that should be 3500. So 34,664. 664. Long-term liabilities, you just add them together. And the same for your trade payables. You add them together. No adjustments there. And for your taxation. So hopefully then, when we add our equity and our liabilities together, so equity is 34 plus 3 plus 3, gets us to 4875, which thankfully they balance. So the key thing is there, where the majority of marks are going for statement of financial position, is not adding two figures together. It's the key workings, your non-controlling interest, your retained earnings, and your goodwill. And all of them involve smaller adjustments that you should be able to present and make it clear to the examiner where the figures are coming from. Because that's the key thing there, is keeping it neat and being efficient in terms of your time management. So once you have your statement of financial position complete, you will then complete your statement of profit and loss and other comprehensive income. Again, it's similar to before, as long as you have all the adjustments in. And remember, as you go down along here, you're trying to track what the relevant adjustments were. So when you track down here, you're looking for anything with the star goes into the statement of profit and loss or other comprehensive income. And we've been lucky that we've tracked them as we go, so there we don't have any major adjustments. We're just going to slot them in. So in this case here, we're going to sum across parent plus sub plus adjustments right the way down. So it's just adding up the parent plus the adjustments. So you can see for other income, we're only left with €100, which must be the investment income from the Simple Investment Guild, because all the other investment income was actually intergroup dividends, whether it was ordinary dividend or preference dividend. So let's sum up these to get our operating profit, and then profit before tax and profit after tax. So once you actually have the adjustments in, it's relatively straightforward totting exercise at the very end to get a profit after tax of 3.55 million. But where students lose a lot of marks is they actually forget now that they have to put in the attributable to and you split between owners of the parent and the NCI. So you need to split that profit 3550 between, is that going to the NCI or is it going to the parent? And this is where the S comes involved, because you have to look at profit for the subsidiary for the year was 1735. It's not as simple as multiplying that by 40%, because you need to say, well, is there any other adjustment to sub profit for the year? There was an adjustment of 30 because you reduced or increased depreciation. That means you reduced sub profit. So for the NCI, it's going to be 1735 minus 30 because you reduced profits with the depreciation charge. And there's a trick here and you need to watch it. It's minus 90 as well for the preference dividend, because the NCI doesn't get 40% of the preference dividend. So you multiply that by 40% and then you add back the 90 times 10%, because they're only getting 10% of that, not 90%. So if I just take that, I should probably put it down in a separate working. So the NCI figure here is actually going to be the sub profit minus 30 for the depreciation adjustment, which hit the subs accounts. Take out the preference dividend, because that is at a different percentage, and put it on at 10%. So here it will be 1735 minus 30 minus 90 times 40% plus 90 times 10%, which is 655, and then the balance will be from the parent. So that's important. There will be a good few marks going for to show that split number one, and also to actually get the accurate calculation. The majority of the time you'll be just looking for S label as you've gone through the smaller adjustments, anything that impacts the subs profits, but also watch if there is a preference dividend during the year, and we know there was from the question, then you have to watch the ownership split and take account of that as well. So that was a relatively tricky part of the question. So once you have the statement of profit and loss and other comprehensive complete and the statement of financial position, you then finish off the statement of changes in equity. And remember, there's 3 steps to the statement of changes in equity. You start with your closing balances, which are the balances from the statement of financial position. So in this case, we have closing balances of ordinary share capital is 20 million. Share premium is 3500. We're not going to put in preference shares because it's gone. It was eliminated in consol. Retained earnings 6174 and NCI is 4990. So we always start with the closing balance first. So we'll just put these as right numbers. And now you're working back to figure out what helped explain that movement to get to our opening balance. So you're going to work in and plug in these figures at the end. One of the first ones is you had dividends during the year. So remember, and reference there journal 4, the dividends that go in will be the parent's dividend of negative 750. So let me just put that in a red one so we know what it is. Journal 4, the dividends were 750 for the parent. And you also had NCI dividend of 209. And the NCI dividend will go in the NCI column, minus 209. So it's important you don't forget to bring them in because they are shown as a movement in the statement of changes in equity. So you have 2 dividend payments for the year. You will also have profit for the year, and that will go into retained earnings for the owner's share of 2895. So you see you need to prepare the statement of profit and loss first before you do this blocky, and the NCI proportion will be 655. So that gets us another movement during the year. And the final movement that students would have forgotten about, if you have a mid-year acquisition, you have to show it coming in to the NCI. So the NCI was acquired during the year, so its acquisition value at the start would have been 4544. So they're the 3 main movements. And by working back, well, the opening balance must have been 20 million as well, because we'd no movement during the year. The opening balance and share premium must have been 3500, again because we'd no balance during the year. Here we start off with the closing balance and we minus the movements during the year to see what the opening balance should have been. And we think the opening balance would have been 4029, and again we can prove that. So we'll come back and prove that at the end. And the NCI, again think about it, if it was acquired during the year, so the sub was acquired during the year, so we should technically have no opening balance of NCI at the start of the year. So let's just check, are we right? Our closing balance minus the sum of our movements during the year is giving us a 0 opening balance, which is correct because we acquired it during the year. So that suggests that overall we're spot on with our statement of changes in equity, and we just can prove this. How can we prove opening group retained earnings? Well, the opening group retained earnings is going to be made up of one of 2 things: the parent and the sub, which in this case is cattle. Now in this case there's going to be nothing attributable to the sub because it was acquired during the year. So we couldn't have any post-acquisition profits in the opening balance. But for the parent, what was the opening group retained earnings to the parent? We're actually told that in the question. It was 4029. So we know straight away we're correct, that the opening balance on the group was 4029. It was everything attributable to the parent. Now sometimes you won't be given that directly and you may have to work back to it, accounting for dividend and profit. Just in this question you were directly given it. You do not have to prove it in the day of the exam, but it's a useful sense check if you have time to figure out whether you've made an error or not. Because if this is not coming back to what you expect it to be, you've probably made a slip somewhere along the line and you should go back and investigate. Right? So that was the 3rd question from question pack number 5. And particularly we're focusing on doing the 3 financial statements, and it's not entirely an exam standard question, but we're layering in a number of adjustments, and the key thing is looking at the 10-step approach or some variation on that to make sure you have a structured approach to these exam standard questions. Because the 2 key things is getting the question done in the time allocated and also ensuring it's neat and easy to follow so the examiner can follow your workings and your logic.